Today we're diving into one of the most powerful tools Canadians have for building wealth, the Tax-Free Savings Account, or TFSA. And here's the big update you need to know for 2026. The TFSA dollar limit for 2026 is $7,000, and that new room is added on January 1st. That's $7,000 of fresh contribution space you can use to grow your money tax-free. No tax on growth, and no tax when you withdraw. Now, if you're an immigrant or newcomer to Canada, listen closely, because this is exactly where thousands of people get burned. Most people hear $7,000 and think, perfect, I'll just dump money in and watch it grow. But there's a catch that can get expensive fast. If you contribute more than your available TFSA room, the CRA can charge a 1% per month tax on the excess amount for as long as it stays in your TFSA. That's not a one-time fee, it's monthly, and it can quietly turn into hundreds or even thousands of dollars. So in this video, I'm going to walk you through the 3 critical rules every immigrant and newcomer needs to know to use the 2026 TFSA room safely and actually benefit from it. By the end, you'll know how to calculate your personal TFSA room the right way, how to avoid the over-contribution trap, and how to invest inside your TFSA like a long-term pro without overcomplicating it. Quick disclaimer, this is general education, not personal tax advice. Your exact situation can be different, and rules can change over time. Always double-check with CRA guidance or a qualified tax professional for your case. All right. First, what is a TFSA really? A TFSA is not just a savings account. It's a registered account, a container where you can hold cash, GICs, mutual funds, ETFs, or even stocks. The magic is that any growth inside the TFSA is sheltered from tax, and withdrawals are tax-free too. And unlike an RRSP, TFSA withdrawals do not count as income. That's why the TFSA is so flexible. It can be used for an emergency fund, saving for a car or a down payment, long-term investing, or even extra retirement savings. Now here's the part that confuses newcomers. In 2026, the annual room is $7,000, but your total TFSA room depends on your personal history. If you were 18 plus and a Canadian resident every year since TFSAs started in 2009, your maximum cumulative room by 2026 can be as high as $109,000. But most newcomers are not in that category, and that leads us to rule number 1, the biggest newcomer mistake. Rule number 1, your TFSA room starts accumulating only from the year you become a resident of Canada for tax purposes and you're 18 plus. It does not automatically go back to 2009 just because you arrived in 2026 or 2023. Here's a simple example. Let's say you became a resident of Canada for tax purposes in 2023. Your TFSA room would generally start in 2023 with that year's limit of $6,500. Then you add 2024, $7,000, 2025, $7,000, 2026, $7,000. So by January 1st, 2026, your total room, if you never contributed, would be $27,500, not $109,000. And this is where people get crushed. A newcomer sees $109,000 online, thinks it applies to them, deposits a huge amount, and then CRA starts charging that 1% monthly tax on the excess. So write this down. Newcomer TFSA room begins the year you have residency for tax purposes and you're 18 plus. Everything before that does not count for you. Now, a small but important detail. In most of Canada, you need to be 18 to start accumulating room, but in some provinces, you may have to be 19 to actually open the account because of contract rules. If that applies to you, you typically still carry forward the room from when you turned 18. You just open the account later. Okay, rule number 2. Rule number 2, to contribute to a TFSA, you need a valid SIN, and you must be a resident of Canada for income tax purposes at the time you contribute. This is important because many immigrants think you must be a permanent resident or citizen to use a TFSA. That's not the real rule. The key is resident for income tax purposes and valid SIN. That means some temporary residents, like people on work permits, can be eligible if they're considered residents for income tax purposes and have a SIN. and some people who are physically in Canada may still be considered non-residents depending on their situation. And here's the warning that saves people from a painful surprise. If you become a non-resident later, you stop accumulating new TFSA room, and contributions made while you're a non-resident can be taxable. So if you move out of Canada and become a non-resident, do not keep contributing like normal. That's a penalty trap. Now, rule number 3 is what makes the TFSA insanely flexible, if you understand it. Rule number 3, TFSA withdrawals come back as contribution room the next calendar year, not immediately, next year, next. So yes, you can withdraw money tax-free, and that amount gets added back to your room on January 1st of the following year. Example, let's say you contributed $10,000 over time and it grew to $15,000. You withdraw $8,000 for an emergency. That $8,000 is added back to your contribution room next year, on January 1st. This is why TFSA can be used as a hybrid account, emergency plus investing, especially for newcomers who may face big life expenses in the first few years. But here's the mistake. If you withdraw and then recontribute in the same year while you're already near your limit, that recontribution counts as a new contribution and can trigger overcontribution penalties. So always remember, withdrawals restore room next year, not this year. Now let's talk about the most practical part. How do I know my exact TFSA room? The CRA. My account portal can be helpful, but you must understand this. The TFSA room shown in CRA My Account is typically updated only once per year in the spring, after financial institutions report the previous year's TFSA activity. That means the number you see can be wrong or incomplete during the year if you've made recent contributions or withdrawals. So the safest method is track your TFSA contributions yourself using your Bangkok broker statements. Then compare with CRA's records when they update in the spring. If you're brand new to Canada, make sure you file your first tax return as soon as you're required to, because CRA tracking is much smoother after you're in their system. Now, if you've accidentally overcontributed, here's the emergency move. Withdraw the excess as soon as possible. Don't wait for CRA to contact you. The longer it sits there, the longer the 1% monthly tax keeps running. Okay, now that you know the rules, let's talk strategy for the new $7,000 room in 2026. If you have the cash available, contributing earlier in the year gives your money more time to grow. If $7,000 at once feels heavy, do this instead. Set up an automatic monthly contribution of about $583 per month. That way, you max out the TFSA without stress. Now the next question is the most important one. What should you invest in inside your TFSA? Here's the simplest, beginner-friendly approach. Use low-cost, diversified investments. A lot of newcomers get sold expensive mutual funds because they sound safe, but fees silently destroy returns over time. A popular beginner choice is an all-in-one asset allocation ETF, something that automatically holds a diversified mix of investments inside one product. For example, some Canadians use ETFs like VECT, more aggressive, 100% equities, or VGRO, more balanced. These are examples, not recommendations. Always choose based on your risk tolerance. But here's the key point. The fees on broad index ETFs are usually much lower than typical mutual funds. And if you're wondering why this matters, think of it like a leak in a bucket. A small leak, year after year, becomes a big loss over decades. Now, very important, returns are not guaranteed. Markets go up and down. There will be years your TFSA investments drop. That's normal for long-term investing. But to show why time matters, here's a simple hypothetical example. If one $7,000 contribution grows at an average 6% per year, hypothetical, after 20 years it could become roughly $22,000. After 30 years, roughly $40,000. And that's just one contribution. Imagine doing it every year. That's the compounding advantage TFSA gives you, growth without tax drag. Now, if you're a newcomer building stability and you're not ready for market ups and downs yet, that's okay too. You can use safer options inside a TFSA, like cash or a GIC. Just remember, interest rates change over time, so always check current rates before making a decision. One more quick warning. Even though TFSA growth is tax-free, that doesn't mean trade like crazy. Overtrading is one of the fastest ways beginners lose money, because emotions take over. The best TFSA strategy is usually simple. Automate contributions, buy diversified investments, and stay consistent. Now, a quick family tip. Each adult in Canada has their own TFSA room. So if you're married, both spouses can build TFSA balances. And yes, one spouse can gift money to the other spouse to help them contribute to their own TFSA. The contribution uses the receiving spouse's room. And if you have kids who are 18 plus and residents for tax purposes, they can also start building TFSA room. Now, quick TFSA versus RRSP comparison, because people always ask. RRSP gives you a tax deduction today, which can be powerful if you're in a higher tax bracket. But RRSP withdrawals are taxed as income later, and withdrawals don't come back as room. TFSA gives no deduction today, but growth and withdrawals are tax-free, and withdrawals come back as room next year. That's why many newcomers start with TFSA first, especially if they're in a lower income bracket while they establish themselves in Canada. One exception, if your employer offers RRSP matching, take the match first. That's free money. All right, quick recap of the 3 newcomer rules for TFSA in 2026. Rule number 1, your TFSA room starts accumulating only from the year you become a resident of Canada for tax purposes, and you're 18 plus. Rule number 2, to contribute, you need a valid SIN, and you must be a resident for income tax purposes at the time you contribute. Rule number 3, withdrawals add back to your room next year, not immediately. So don't withdraw and recontribute in the same year if you're near your limit. If you follow those rules, check your room properly, and invest consistently in diversified low-cost options, the TFSA becomes one of the best wealth-building tools in Canada. If this video helped you, hit like, subscribe, and turn on notifications. I'm posting new Canada finance videos regularly for immigrants and newcomers who want to build real wealth the smart way. And comment below. What's your TFSA plan for 2026? Are you maxing the $7,000? Are you doing monthly contributions? And what year did you become a tax resident of Canada? Thanks for watching. Stay smart, stay invested, and I'll see you in the next one.